As usual, we'll share with you the latest reports from the central banks on corporate deposit levels, continuing their upward trend. But we also want to share with you some very intriguing trends in central bank reserves that we have been alluding to for a while, but that we believe now clearly indicate an untold story. And we want to discuss the potential impact to corporate recent regulations. So the liquidity ratio plank of Basel III, which could be the single most impactful for corporate treasurers in the post-crisis era, and the impact of the new money market fund regulations on investment policies. And last but not least, we will discuss the above topics and other key game changers with our panelists to hear their views on the implications for you and the market. A quick preview of the next 45 minutes. Covering the topics just discovered. So Tony will share the latest reported cash levels. I'll review the potential impact of Basel III's LCR on corporations. Tony will then share the very interesting findings on central bank reserves. I'll review the money market fund regulations and your investment policies. And then I'll introduce the panel, which Tony will facilitate, and then I'll wrap up. A word before we get started. Our 45 minutes today gives no time for live Q&A. However, we want to take your questions, so please type them into the question box in the bottom right-hand corner of your screen, either during or at the end of the webinar. We'll circulate the answers to all who have called in. One more quick word. Over the next 4 weeks, we will be attending several Treasury conferences in Europe and the U.S. If you would like to meet with us at the upcoming AFP, Eurofinance, SAP Treasury, or NACT conferences to discuss the topics we're discussing today or anything on your mind, please let us know and we will set up a meeting. So Tony, what are we seeing in the latest from the central bank reports on the latest cash balances?
Thank you, Moni. Well, it's been a monumental quarter from a number of perspectives, as you just laid out in your introduction. Corporate cash continues to increase. As we look across the jurisdictions, the U.S., UK, Eurozone, and Japan, the trend line continues. You know, we've seen a lot of headlines lately and some survey results out saying that corporations are reinvesting their cash or employing their cash back in their business. And while that may be true, the pace of accumulating cash, in spite of that, continues. If you look at the top left-hand corner here, for example, in the U.S., while we had a downturn in the first quarter, there was about a $30 billion increase in corporate cash in the second quarter of 2014, and that represents a year-over-year increase of 8%. So we still have cash building at a fairly healthy rate, and we see the same trend in the UK. The Eurozone, interestingly enough, the ECB has not reported out its cash numbers since December of 2013. There have been a couple of scheduled releases, and the release dates came and went without a release. We're now expecting on October 20th, I believe, to find out what the most recent Eurozone number is. You know, a couple of reasons or a couple of hypotheses we have as, you know, Treasury strategies as we consult with our corporate Treasury clients. You know, there's still a sense of a need to accumulate cash as a precaution. You know, cash almost as a balance sheet hedge, if you will. Our corporate treasurers and other clients tell us that they still see a lot of uncertainty. For the first time, they're beginning to understand that the regulatory impact of things like Basel III and money fund regulations now are really coming into focus. We're going to be talking about these. Moni's going to be talking about these in a few minutes. But the sense is that they will impact corporate treasurers. They will impact all of you. And while those impacts are still being fleshed out and are uncertain, companies are holding on to cash. And then finally, and we'll also be discussing this in a couple of minutes, there's divergence in economic performance in different regions around the world, which further creates uncertainty as, you know, you treasurers don't know whether, or none of us know, whether, you know, one region's growth is going to fuel growth in other regions, or one region's slowdown is actually going to cause a global slowdown. So as a result, precautions continue. Now, as we look at cash by region, the numbers remain very stable from the past couple quarters, although changed significantly from way before the crisis. In the U.S., corporate cash is now 11% of U.S. GDP. That's up from 9% at the beginning of the millennium. The Eurozone has gone from 14 to 21%, so there's a lot more cash on the balance sheets in the Eurozone. The UK has gone from 25 to 34, and Japan 36 to 49. To some extent, this is a measure of capital efficiency, both the efficiency of the corporations and the efficiencies of the regional capital markets. It's an interesting statistic, and I might add, we've been reporting this now for 10 quarters, and just 2 weeks ago, The Economist magazine began reporting similar numbers. So we'll put a little feather in our cap for that one. Now, the next thing we'd like to look at are the balances the banks maintain as reserves at the central banks, because we think this is telling just an incredibly interesting story. We're going to do a deep dive on this later on. As you know, we report this out every quarter, and beginning about 3 quarters ago, we sensed that there might be something going on in the background here among the various regions, and we promised to do a deep dive. So we actually have a section later on this morning that will deal with this. Starting with the top left, though, you can see that the U.S. has gone from about actually $40 billion of reserves prior to the crisis in June of 2008 up to currently $2.7 trillion in reserves. If you look at the upward sloping part of the graph around June of 2013, you can see the quantitative easing program where the Fed was stimulating by $85 billion per quarter, and then you can see the tapering. So in the U.S. at the Federal Reserve Bank, the rate of growth is slowing. Moving along to the right, we can see at the Bank of England, it's actually been flat for about 3 years. And, that obviously leads to the question, well, why was the Bank of England flat while the U.S. was stimulating? Going down to the bottom left, we see at the European Central Bank, reserves actually peaked early in 2012 and have plunged since then. And in fact, the current level of reserves is back down to pre-crisis levels, which is obviously very different than what we see from the other central banks. And, it raises questions like, over the course of stimulus, the LTRO programs, negative overnight rates, why is it that the ECB numbers are falling precipitously at the same time that the Fed and the Bank of England are not falling? Then we look at the bottom right, and we see at the Bank of Japan, particularly in the last year or so, reserves are skyrocketing, and that's a very well publicized Japanese stimulus program. So going across all 4 of these, we see 4 very different performances. The U.S. rising but more slowly, the U.K. flat, the ECB plunging, and Japan skyrocketing. And so, it's no question why corporate treasurers are confused and concerned, and therefore holding more precautionary cash. And in the 4 largest market regions of the world, we see four very different kinds of monetary policies going on. And obviously, from the standpoint of view of the corporate treasurer, you have to be asking questions like, what does this mean for my short-term investments? What does this mean for my long-term investments, my business prospects, my balance sheet, my access to credit? There are a lot of factors that come in, and when you see the 4 major economies of the world moving in 4 different patterns, that certainly has to be cause for concern. I'll leave it there. We're going to come back to this in a few minutes. But next, I'd like to turn this back to Moni for discussion of the liquidity coverage ratio plank of Basel III, which is one of the concerns now landing on your desk.
Thanks, Tony. So we could actually spend the whole briefing or the whole day or a whole week on the liquidity coverage ratio, what it is, what the potential impact is. We don't have that time, but the point we really want to make here is that we believe that the liquidity coverage ratio could be the single most impactful regulation for corporate treasurers in the post-crisis era. So let's take a quick look at what it is and the potential impact to your organization. So first, the LCR was put in place to ensure that banks have sufficient funding to withstand a crisis. The second, and the one that impacts you, it will require banks to reclassify corporate deposits in two categories. The first, operational deposits, which are used in your daily cash management and payments operations. Banks can use these funds that are defined as operational deposits to make loans, leases, and conduct other general banking activities. Now, the non-operating deposits, which are any of your deposits in excess of your daily needs, or their interest-sensitive deposits not subject to the 30-day withdrawal limitation. Banks can no longer use these deposits in their general banking operations, and they must invest these deposits only in high-quality liquid assets, which means that the return, that it changes the economics because the return on high-quality liquid assets is low, and so these deposits will have far less value to the bank. So if we can turn to the next slide, the LCR, as obvious from the above, significantly alters the economics of a banking relationship, both from the Treasury's perspective, and from your bank's perspective. So banks generally will, and really are already looking for operating balances and discouraging non-operating balances, and many of you may have already seen that in some form. They will want you to put your balances, any non-operating balances, in 30-day or longer time deposits, or else find another home for them. And we expect to see changes, and are really already, and are helping some of our banking clients with these, but we expect to see changes in service pricing, as well as new services and products and rate structures. Now, the thing to keep in mind is that the attractiveness of your deposits will depend on the volatility of your cash flow. Banks are looking for stable operating balances. Your ability to accurately forecast your deposits, to know which can be placed in longer-term deposits, and to minimize the volatility with the bank. The mix and amount of services you buy from your banks, with operating services clearly preferable. The nature of the business activity which underpins your transactions, so commercial transactions versus financial transactions. And finally, legal arrangements surrounding your accounts, such as escrow accounts. So we believe that at some point, one point I wanted to make earlier was that not all banks and not all customers will be impacted in the same way. However, we do believe as a result of this change in the economics that it's likely at some point you're going to need to redesign your operating banking structure and reallocate your deposits.
Moni, I would add here that, to the extent that you as corporate treasurers can manage your cash in a way that appears stable to your banks, that makes you a much more attractive customer. So balancing the cash flow, being better able to forecast, and that usually means having the right technology in place to do those things, and doing business with banks that can give you full global cash visibility becomes very important.
Okay, Tony, let's look at the central bank reserves.
Okay, as we promised over the last couple of webinars, corporate cash briefing webinars, we were going to do a deeper dive into what's happening, and we're asking the question, particularly as we look at the U.S. Federal Reserve and the European Central Bank, is there a transatlantic arbitrage going on here, and is in fact all this stimulus doing nothing more than being recycled by global banks from one central bank to another? So here we see this on this page, the chart that we saw before with the U.S. reserves going from 0 to 3.7 trillion. The ECB going from about 200 billion euro pre-crisis up to 900 billion euro, and now back down to 200, which is quite a roller coaster and substantially different from what we're seeing elsewhere in the world. So one of the first things we did was look at the composition of the reserve balances at the U.S. Federal Reserve. And what we've done here on this chart is separated out the reserves on deposit at the Fed that have been deposited by U.S. headquartered banks, separate and apart from those deposited by foreign banks doing business in the U.S. And we find actually today 54% of all of the reserves on deposit at the U.S. Federal Reserve have been deposited by foreign headquartered banks doing business in the U.S. So what we have are the thousands of U.S. banks, that blue line, representing about 1.3 or 1.4 trillion worth of reserves, and then the large global banks doing business in the U.S. but not headquartered in the U.S. representing even more. So, obviously you have to ask the question as you look at this chart: why are global banks putting money at the U.S. Fed rather than elsewhere? And as you can see from this chart, the rate is growing. And then obviously the final question is, and the real payoff question is, what does this mean for corporate treasurers? So what we wanted to do then, if you look at the graph in the top left here, those the blue bars represent reserves on deposit at the ECB. So these would be the reserves of banks doing business in Europe, and we've translated them back to U.S. dollars. And on top of that, on that stacked bar, we've added the reserves of all foreign banks on deposit at the Fed to sort of get the sense of non-U.S. money that's moving between U.S. and global banks. And what we find is, beginning in mid-2012, that number has been that total has been relatively stable, in about the $1.7 trillion range, plus or minus 150 billion or so, but relatively stable. And the shift out of the ECB seems to be matched unit for unit with increased deposits at the Fed. So is what's happening here, we put out as a hypothesis, the European Union stimulus programs, or the ECB stimulus programs, are going onto the balance sheets of global banks, being recycled through their operations and onto the balance sheets of the Fed, actually missing the primary objective of stimulating the economies, money simply moving from one central bank to another and bypassing the real economy. Now, we can't be 100% sure, but one of the things we did, we had our consultants here at Treasury Strategies take a look at the balance sheets of the banks that comprise all of those deposits at the U.S. Fed. And on the bottom right, you can see this chart where we compare the year-end 2009 balance sheets with the current August 2014 balance sheets. And in the far right-hand column, we have a column called Net Due to Related Foreign Offices. We see almost a $1 trillion swing between what flows between the headquarters of a global bank and its U.S. affiliate. And so there's been a $1 trillion positive swing as the U.S. operations used to upstream about $350 billion to their parents in Europe. They've taken all of that back plus another $600 billion onto the books of the U.S. bank. And then in the middle column, we see foreign-related institutions' reserves at the Fed are up $1 trillion. So that would indicate, a massive restructuring of the balance sheets of the foreign banks doing business in the U.S. and perhaps indicate that there is $1 trillion that had moved essentially from the ECB to the Fed. Now, why is this important? Well, the key issue here is these deposits are essentially overnight or 1 week money, so they could move back like at the flick of a switch. That's a huge tidal wave impacting the capital markets, and that could easily happen. Doing a small change of interest rates, that will impact the liquidity available in the markets, and depending on how fast it goes and how it goes, different segments and different regions may be impacted differently in terms of excess liquidity or insufficient liquidity. And certainly we have huge currency flows, and that obviously will have foreign exchange and exposure and hedging considerations. So we think that there's something significant going on here, and the unwinding of this will interject uncertainty in the markets. This is probably behind, way behind, but the need to actually be holding more cash. So with that as a deep dive, let's go back to Moni. One other regulatory item before we get to our panel is the new money fund regulations, which in the U.S. were promulgated a couple of months ago and are currently being considered again in the European Parliament.
Great, Tony. Thanks. So when the new regulations came out in the U.S., there was lots of concern about what that means for investments and what's allowed under investment policies with companies. And there's been, in some corners, there have been cries of the sky is falling. Actually, we took a look at 15 current investment policies of some of our larger clients. And what we found that was that at the board level policies are written so broadly that it's not at all clear that there needs to be a change. Doesn't mean there doesn't need to be change, but it's not necessarily clear that there's one. And we think some of these policies will hold even under the new regulatory environment. But let's take a look at broadly what the regulation is, not going deeply, and whether or not these new regs require changes to the investment policies. So if you look at the main features of the regulation, whereas before it was constant net asset value, now it allows a fluctuating net asset value. So basically, it requires all instruments with a remaining maturity more than 60 days up to the 397 days max to be marked to market. Then it also allows for the possibility of liquidity fees or exit gates. I think it's important to note that in both cases, the regulation allows the fund boards to put these in place, but does not require. It also allows for enhanced disclosure and stronger portfolio management requirements. And these, when they're implemented in October of 2016, will primarily focus on institutional prime and institutional municipal funds. So actually, when we looked at the regs, they really mitigated many of the concerns we had, as well as many of you had, raised during the consultation process. So from a corporate treasurer standpoint, the impact is not nearly as bad as we all would have thought it would be a year or two ago. And these 4 points, I think, highlight that. There's significant record-keeping relief under the new U.S. Treasury IRS guidance. So it eliminates the need to track daily purchases and redemptions for tax reporting. There's relief from the wash sale rule, so there's substantive tax relief there. Under the preservation of amortized cost accounting for securities maturing in 60 days or less, the NAV fluctuations will be smaller than if the entire portfolio floated. And there are enhanced tools for fund boards to act in the best interest of the fund shareholders. So we do, if we can go to the next slide, this regulation does require careful evaluation of the language in your current investment policies. But again, we think many of your policies may hold true for the new regulations. So for example, a stated objective in your policy is preservation of principal. The rule doesn't necessarily rule out VNAV funds. Even commercial paper and government securities fluctuate in value daily. So unless held to maturity, all money market instruments fluctuate. Another example is if your stated objective of daily liquidity, it does not necessarily rule out funds subject to fees or gates. Fees and gates are board options, so they are not required. The requirement in the regulation is that the board act in the best interest of the fund shareholders. And the fee is analogous to an early withdrawal penalty and a bank time deposit, and each can be avoided by continuing to hold the instrument. Gates are analogous to bank holidays and withdrawal suspensions, extremely rare but authorized under various statutes. Even an FDIC-insured deposit at a failed bank can be gated. Regulations stipulate only that the FDIC must begin the process of resolving a bank failure within 48 hours. And then if you see more restrictive language, such as a constant net asset value requirement, that would necessitate a policy change to permit continued investment. So really what we're trying to say on these two slides is there's a lot of concern that it's going to require major changes in your investment policies. We're not certain that's the case. However, all smart treasurers, as you all are going to be discussing and raising the issue with your CFO and your board and determining whether it necessitates a change in your investment policies. Tony, would you add anything here?
Well, one thing I would say, Moni, in our review of these 15 investment policies from Treasury Strategies clients, these were all large global companies and 2 not-for-profits. And the closest we came to a requirement for a constant net asset value that we saw in these policies, 2 had a statement that said that the manager shall strive or can only invest in funds who strive to maintain a $1 net asset value. All funds strive to maintain a $1 net asset value. It's not clear how you would interpret that, but your advice to have a conversation up the chain of command is really the way to resolve that, and that may or may not require a formal change to the investment policy.
Okay. Well, great. I'm sure we're going to discuss this more with our panel. So we want to move into the game changers in the panel. And if we look at the game changers, we're not going to spend time on them here, but these, at least 3 of the topics we've already covered: the LCR, the money fund regulation, harmonization, and that's what Tony alluded to. The U.S. has passed the regulation. We have to see what happens in Europe. Investment policy changes, and then the European Central Bank's negative interest rates. So let me introduce the panel and we can get started. Debbie Cunningham is Executive Vice President and Senior Portfolio Manager and Chief Investment Officer for Taxable Money Markets at Federated Investors, a leading investment management firm and pioneer on money market and fixed income funds. Ian Rasmussen is a Senior Director of Fitch Ratings, a leading global provider of ratings, commentary, and research. As Director of Funds and Asset Management Rating Group in New York, Ian is responsible for Fitch's U.S. coverage of money market funds, closed-end funds, local government investment pools, and asset managers. In this role, he's responsible for assigning ratings, developing rating criteria and models, and publishing timely research on analytics and regulatory developments affecting these industries. So we're excited to have the panel, and Tony, I'll turn it over to you to facilitate.
Thanks. Welcome, Debbie and Ian. We're glad to have you back. Let's start with the upper left-hand corner here. The current negative interest rates, the overnight interest rate in the ECB, as well as interest rates ticking negative in markets. Let's start with Debbie. As a manager of funds in these jurisdictions, how do negative interest rates impact the management of a fund?
Well, thanks, Tony. And generally speaking, nobody wants to have a negative rate of return on any of their investments, let alone their cash investments. So it is definitely something that from a stable net asset value provider of money market products and cash investment products, we try to avoid. So having said that, in the U.S. over the course of the last 5 years, there have been various points when treasuries, for various instances, for very short-term time periods, have gone negative. You didn't see a whole lot of buying of those securities. It's different from a context of what we're seeing in the Eurozone at this point, though, because the base rate is negative. We've got negative 20 basis points from an overnight perspective. We never had that in the U.S. So it's not just market forces that are taking the rate negative. Policy makers have taken the rate negative. What you effectively have that's helping a little bit is a curve that gives you positive rates once you go outside of, let's say, the most liquid sectors of the market, 1 month, 2 months, and into, sort of the 3 month and out, 3 months to 12 month sector of the marketplace. So even though nobody likes to buy negative rates and effectively attempts to avoid them, as long as you can balance in a barbell fashion your overnight to 1 month most liquid paper that may or may not, some portion of it, be negative in its component rates, with the longer end of your barbell having something that's quite positive from a rate perspective. And we're talking about Euro prime funds, not Euro govie funds. That's a whole different story. Then you end up with something that on a fund level basis continues to be positive. So, right now that's the state of things. You have the phenomenon going on there from a Eurozone perspective that is similar to what we've experienced here in the U.S. over the last, 6 years or so, which is fee waivers from the fund companies, so that even on a net basis, you're still either at zero or slightly positive rates from a client standpoint. The fact, though, that the policy rate is a negative rate is one that, is a little bit more difficult to contend with. And given what's happening from an economic perspective over there, there's not a big light at the end of the tunnel yet at this point.
So, Debbie, the strategy that you just laid out, for Federated, which manages hundreds of billions, is something that you can certainly employ. I would imagine that this would be difficult for any individual corporate treasury department to execute on their own, though. I mean, this requires a real ringside seat on the market.
Well, I think not only does it require a little bit of a ringside seat, but it also requires the ability to go out a little bit longer for some portion of your portfolio, and that necessarily makes some treasurers, and corporations a little bit queasy when you talk about that. So I think we're definitely looking at something that from an, a qualified advisor perspective lends you toward that type of an end result.
Sure. Now, Ian, as someone who rates these funds, does a fund that invests in negative yielding instruments impact the way you develop your ratings?
No, it hasn't. We've actually publicly commented on a couple of things that are happening in the market right now. Our European colleagues have been watching this pretty closely, and what we've seen for Fitch-rated funds is broadly speaking, is as Debbie mentioned, with funds extending maturities to be able to collect additional yield kind of further out the curve. We have seen a couple of funds, fund complexes institute reverse distribution mechanisms to also, look forward to further negative rates. Right now, it's, as Debbie mentioned, negative 20 basis points. But typically, money funds accrue income daily, and they distribute this to investors on a monthly basis in the way of new shares. On going forward, for the funds that have instituted reverse distribution mechanisms, days that yields are negative, the process is reversed, and the mechanism allows for shares to be canceled. So you maintain the dollar NAV, but you account for the negative yields. We feel like that this is something that kind of is talked about with investors, that investors understand this, and it's a way to combat negative rates without large impacts on investors or the fund.
So, Ian, some funds have refiled their registration statements and developed prospectuses that discuss reverse distribution and give them permission to do that. Has anyone, have any funds done that yet? Have actually had a reverse distribution?
I don't believe that funds have actually started the reverse distribution. I believe that this is more of setting up the program in case that they need to. Looking prospectively, managers not wanting to have to close funds or liquidate funds, but setting this up as more of a way to to look forward in case things get worse.
Fantastic. So moving around the going clockwise here, the next game changer we had is the liquidity coverage ratio, and as Moni laid out very clearly, impacts the way banks and their corporate customers interact with each other and changes the economics of that equation. I would think that money market funds would be not necessarily caught up in that specific regulation, but might be the beneficiary of funds flowing out of banks the banks view as non-operational. And I wouldn't have expected any of that to happen yet because the regulation is still in the implementation period. Debbie, have you seen any fund flows that may have the LCR as the underlying motivation at this point?
We have not seen that, Tony. It's something that we kind of watch out for. We certainly saw it go the other way, several years ago when bank deposits built up to a pretty large number while money funds remained pretty flat. But we've not seen the reverse of that occur at this point.
Interesting. I wouldn't have expected that. So, Ian, as we move along on these game changers, we have money fund regulatory harmonization. So, since the financial crisis, regulators have been talking about the need to harmonize globally across all jurisdictions. In the U.S., the Securities and Exchange Commission on July 23rd came out with a set of money fund rules. So it seems to me, just being a simple guy, that harmonization would mean that the European Parliament will adopt what the SEC adopted. Do you think that's going to happen?
At this point, it's very hard to say if that's going to happen or not. I guess, from the perspective of harmonization of regulation, I guess it's somewhat, it's a positive that when they were getting ready to vote last year, that there was some dissent on some of the proposals, and there was, a need for further discussion. And so I think that they're, as they take the matter up again, that there at least is the room for further discussion and not necessarily being beholden to the to the proposals that were laid out. So it certainly could happen, but it's hard to give an opinion of yes, that they're going to be focusing on what the SEC did and trying to harmonize.
Right, and we have to point out in Europe, different countries within Europe actually have different regulations at the current time. So there will be a lot of changes once the European Parliament actually does come up with a rule. So Debbie,
sure.
As you watch the European regulatory process unfold, the European Commission developed a set of proposals that then went to the European Parliament last spring. The Parliament dissolved, a new Parliament has been constituted, and may or may not bring this up in at some point in the future. What are you seeing there?
Well, certainly, I think investors and, the industry's desire for harmonization from a regulatory perspective is pretty strong. Having said that, the main difference, if you will, for what was originally proposed and then, decayed from a European Parliament perspective back in March of earlier this year, was due to the sort of FSOC nature of the proposal that had to do with a mandatory 3% capital if you wanted to keep constant net asset value, participation within your product. So that's the one that was the biggest differing point, and it seemed to stem from a European perspective out of what the original proposals from FSOC contained. So that's long behind us now from a U.S. perspective, and it certainly seems as though the tide has turned from a European perspective. Very, various comments from quite a few people in the know seem to feel pretty comfortable that 3% capital or capital of any form, capital buffer of any form, will not be part of the next set of proposals that will be addressed from a money fund regulatory perspective within European Parliament. Having said that, if you kind of look at where we are from a U.S. rules perspective, with the gates and fees, the offshore funds for the most part, European funds for the most part already have that capability. It's enhancing it, if you will, with the ability for directors and oversight to come, based on certain trigger levels, that sort of thing. So I think that's a pretty easy one to think that will be crossed. That path will be crossed and taken. Disclosure and diversification. Certainly, if you look at where we got to in the 2010 amendments in the U.S., as well as some of the add-ons for the 2014 amendments in the U.S., none of those have been addressed in the offshore market yet. So having that is a big positive, and hopefully that gets built right into what we see from a regulatory perspective in Europe for these funds. And then lastly, with regard to stable net asset values, I think there's not much of a exempted market, if you will, from a European perspective compared to what we have in the U.S. So what was exempted from the variable net asset value side of the equation in the U.S. was retail and government. Neither one of those are very large sectors of funds in Europe. So effectively, it will be the largest portion of the market that is impacted, if you will, even with sort of the model that's been set up from a U.S. perspective. So I think that should give European Parliament a little bit of a cover and comfortability that again, that's the right path to take. But with Italy as the president now, they've declined to say whether or not they will address it. I know it will be discussed, but whether it actually gets brought up from a rulemaking perspective remains to be seen. Certainly doesn't seem like the next presidency, which will begin in early part of 2015 with Latvia, will address it. So possibly we're to where Luxembourg becomes president in the second half of 2015 before it's ever really brought to the test again from a European Parliament standpoint.
So the clock still ticks, but there could be as much as a year before we see where we are there.
Yes.
Okay. Ian, as Moni discussed the changes that corporate treasurers may or may not have to make with respect to their investment policies as a result of these money fund regs. Many of the policies that we looked at, however, limited investment in AAA rated money market funds. So you can invest in a money market fund provided that it were AAA rated. Do the regulatory changes that have been put forth change the way you look at how you rate a fund?
Well, I think that there certainly will be broad implications for the market, and we'll be watching to see how those develop over time. I would just say right now what we've been watching very closely is across all of the funds that we rate to see if there have been any pressures in terms of investor redemptions or changes, big changes in investment strategy, and that just hasn't been the case at all. What we've seen actually is very stable assets under management after the, coming up to the reform and then afterwards. So they're really, and managers in addition to that have been keeping very high amounts of liquidity and have been managing the portfolios very prudently. So as we move forward into the implementation period, and as we consider the types of market changes that this reform will have, the impact that it will have, we'll be watching those developments, but we're not anticipating at this point any kind of sweeping changes to ratings on money market funds. We feel like that they are still managed very conservatively, very safely, and we haven't seen really any kind of systemic pressure on the funds themselves.
And Debbie, would you concur with Ian's assessment here? And let me restate the question just a little bit differently. That is, so if a corporate treasurer's investment policies currently say you're permitted to invest in money market funds that are AAA rated by one of the major rating firms, the regulatory changes that are put in place will probably not disqualify a company from investing then.
I think it wouldn't disqualify them from investing in the new type of money market fund. Where I think I'd be careful, though, is anything that actually refers to that name, money market fund or 2A7, only because I think there will be private fund products that arise out of this regulatory change that mirror, from an investment policy perspective, the requirements that a money fund has to maintain for risk mitigation purposes, but that have a different wrapper or package that doesn't require them to be under the SEC's 40 Act Rule 2A7 review. So, you know, maybe describing a little bit more in the context of, you know, what the investment policies and risk mitigation requirements are that they have, as opposed to actually using those words, money market fund or 2A7, or maybe they do it in a like format, you know, from an investment perspective, money market fund like, 2A7 like, as opposed to requiring them to be of that particular regulatory oversight.
Oh, that's good advice. So an investment policy that said you may invest in 2A7 funds or funds with similar investment policies or similar.
Yeah, something like that, yeah.
Excellent. Well, thank you. This has been really helpful information. Let's go back to Moni for a quick wrap-up.
Okay. Thanks, everyone. Thanks, Debbie. Thanks, Ian. And thank all of you for joining us. And again, a special thanks to our panel.